Remember when I told you that what you're about to learn might make you wish you'd known it years ago? Well, this is that lesson. Today, we're going to pull back the curtain on something that could completely transform your financial future. We're going to do two things that might just revolutionize how you think about mortgages. First, we'll explore why a mortgage structure matters more than its interest rate, and this is going to surprise you. Then I'll introduce you to an alternative that most banks don't want you to know about. Let's start with something we all know, the 30-year fixed rate mortgage that 9 out of 10 Americans choose. You know the drill. Shop for the lowest rate, celebrate when you get it, and settle in for 3 decades of payments. But here's what keeps me up at night. What if we've been focusing on the wrong thing? Yes, these loans have their place. They make home ownership more accessible with lower monthly payments and smaller down payments, perfect for when you're just starting out or when cash flow is tight. But here's where it gets interesting and honestly a bit shocking. Remember how I mentioned my mother still having a loan at 76? Well, let me show you why this happens. Look at this graph. Do you notice something strange? In the first several years, most of your payment isn't touching your actual debt. It's going straight to the bank as interest. It's like trying to bail out a boat with a teaspoon while someone's pouring water in the back with a bucket. And here's the kicker. Most people refinance every 5 to 7 years, chasing those lower rates. But every time you refinance, you're resetting this whole cycle. It's like hitting the restart button on the bank's favorite game. And there are two factors that lead to this high total interest in a 30-year fixed rate mortgage: the length of the loan and the amortization schedule. Now, the amortization schedule outlines how interest and payments are calculated on a loan. And this schedule dictates what percent of your monthly payment goes towards the principal amount of the loan and what goes towards the interest. The amortization schedule that 30-year fixed rate mortgages follow keep the principal balance of the loan high, which keeps the total amount of interest high as well. And then this leads to two main things. One, the principal balance, which the interest is calculated on, remains high, keeping that total interest high as well. Two, home equity growth, which is the difference between the market value of the home and the outstanding mortgage balance, is slowed. This is because the homeowner in the early years of the loan is paying mostly interest. Their debt is very slow to actually decrease, even though they are making that monthly payment. So let me try to make this real for you. Remember our $800,000 loan example with a $160,000 down payment on a 30-year fixed rate loan with that great 6% fixed rate that everyone gets excited about? Well, statistically, 42% of take-home pay will go to paying this mortgage. This is a massive portion of income to be allocated to debt for 30 years. Now, are you ready for the shocking part? The total cost after interest is $1,381,636. That's not a typo. You're paying $741,363 in interest alone. That's almost another entire house. Hell, that is at a minimum one fully paid off investment property in most markets. And to further drive this point, the total cost here is just the loan and interest. This does not include the $160,000 down payment in our overall calculation. We could do a whole other class on lost opportunity having this cash sit idle inside this traditional loan structure. But what if there was a different way? What if I told you there's a loan structure that lets your money work twice as hard for you, where your money and your mortgage work together? It's called an offset mortgage loan, and it's about to change everything you think you know about home loans because it flips the switch on how interest is calculated and leverages daily deposits to lower your principal balance. Here's how it works. Picture this: your mortgage, checking account, and savings account and line of credit are all wrapped up into one smart package. Every dollar in your account actively fights against your interest charges every single day. Your money isn't just sitting there anymore, it's working overtime to save you thousands of dollars. Because as you add money to the account, your calculated principal debt balance temporarily decreases. And each night, the interest is calculated based on the current interest rate and that current principal balance. As your paychecks come in, it immediately starts reducing that interest charge. And that's because, as we just said, the interest is calculated nightly based on that loan balance that day. But what if you need to pay bills? No problem. Your money stays flexible. Interest is calculated daily, not monthly, meaning every dollar counts towards lowering your total cost. At the end of each month, the interest is averaged out, added up, and that equals your interest portion of the payment. So there's no more separate accounts. Everything works together to build your wealth faster. I just want to repeat this again. Every dollar you have in this account temporarily reduces the principal amount of the loan, in return reducing the interest you pay. So you can leave this money there to leverage paying off your loan faster, but if you need it, you can access it. And it gets better. Remember how traditional loans lock away your equity like a money in a vault? Well, not here in this loan. With an offset mortgage, you can maintain access to your equity. So if you need money for a child's education or you want to invest in a rental property, you've got flexibility without having to refinance. Now, you're probably wondering, if this is so great, why isn't everyone doing it? Well, it's simple. One, banks make less money. Now you know why they don't advertise it. Two, most loan officers don't understand it well enough to explain it. Three, it requires higher financial discipline. But hey, that's why you're here. And four, it challenges everything we've been taught about lower rates are better. And the upfront costs can be higher, but the long term savings are incredible. So just because you haven't heard about it doesn't mean you should ignore it. It might be the ticket to building equity faster because you are no longer giving it away in the form of interest payments to the bank. Your money remains available if you ever need it, but it gets you to financial freedom faster if you don't. And here's what I want you to take away from today. Your traditional 30-year mortgage might be comfortable, but it's costing you a fortune. The offset mortgage structure could be your ticket to financial freedom years sooner. You have options that most people never even hear about. Now, before you move on to the next lesson, I want you to do something important. Open your workbook and use the mortgage comparison calculator. I want you to see exactly how much money you could save with this strategy. Sometimes seeing those numbers is all it takes to realize why this matters so much. And remember, this isn't just about paying off the house faster. It's about rewriting your financial future today. And after today, you know something that 90% of homeowners don't. The question is, what are you going to do with that knowledge?